Thank you very much. Can you hear me? Great. Thank you for inviting me again, and I'm so glad to be here again. My assignment today is to talk about the financial markets. As you can see, the title of my talk is Beyond War and Oil, because over the last 2 weeks, well, not last 2 months, everybody was pretty much preoccupied with the Iranian war, the oil crunch, the very high oil prices, what it will do to the world economy. Everybody was very much concerned about. Now you can see that the market has moved on. So when you think about the next big thing here, beyond the war and oil, is really the AI boom. Every day I receive tons of questions from our clients saying, hey, are we in a bubble? How come it is not a bubble? And if it's a bubble, when is it going to burst? And tell me at what point I need to run for cover. So that's the question every day. I'm going to deal with that. I'm going to tell you exactly when to run. If I'm wrong, don't call me, but I'm going to tell you. But before that, I would think that everybody here is an investor, one way or another. Just two very small reminder. As an investor, you always have to keep these two things in mind. Number one, when everything becomes so obvious in our business, it is not. So when everybody thinks that something is so clear, so obvious, that's going to happen, always question about that. Always raise your question. Classic example. For the last 2 months, at the onset of the war, everybody took the view that this oil crunch is going to inflict huge damage on the world economy. And so much so that Goldman Sachs, I hope they are not here, but Goldman Sachs, the major investment bank in the United States, rushed out, raised their recession probability from 20% to 35%. It's on record. You can Google it. It's there. They can't run away from it. 35% probability of recession is huge. I mean, it got more than a third of an odd that the world economy is going to get into recession. But they're not talking about that anymore, obviously, because the market has rallied. Everything looks okay. The key thing I want to mention here is this. What actually happened shocked everybody. Look at the chart here on your left-hand side, top panel. If you look at the top panel, that is the manufacturing business in both EU and the United States. The last two data points was March and April. The bottom panel is China. China is always, fluctuating around, expansion, contraction. But the interesting part here is this. At the time when everybody was worried about manufacturing recession because this thing is going to inflict so much damage to world manufacturing activities, actually, that was the first time that these three major economic blocks have had simultaneous expansion. You can see that. The manufacturing, the numbers here, it's pretty obvious. You can see here it's all moving to the positive territory. And if you look at the chart here on the right-hand side, that's the world manufacturing activity. Actually, it's beginning to boom in the middle of the oil crunch. That was completely shocking. Now, because of all these things are so obvious, people forgot about two things here. If you look at the chart here on your right-hand side, this is very important. Look at the chart here. Basically, don't think it's too fancy terms. Some people call that oil efficiency curve, but actually it's just how much these economies consume in terms of crude oil divided by their real GDP. Think about that as an oil dependency ratio. As you can see that, the ratio dropped dramatically since 2000. For the United States, the oil dependency ratio dropped almost 90%. Look at the blue line, from around 1.4 to about 2 to 3. Look at China, the red line. The Chinese oil dependency ratio has dropped 64%, 65%. Europe, same thing, 55, 60%. So in other words, the oil becomes such a small part of the world economy, it really doesn't really matter that much anymore. It becomes so small, so less dependent on fossil fuel in the world economy that actually the oil crunch, it makes perfect sense right now. The world economy is actually doing fine even with the oil prices going as crazy as it has been. And then another chart people always forget is the chart here on your left-hand side. Look at the red line. The red line is the real oil prices. Even though, if you look at oil prices right now, it's about same as, above the same when Russia invaded Ukraine. That's oil prices went through the roof, 125, something like that. If you look at the Brent oil prices, it's about the same level at the high. But if you look at the real oil prices, it's way lower than the time when Russia invaded Ukraine. It was about a 20% lower. If you compare oil prices in real terms today versus 2010, when oil prices was about, $150, in real terms today, it's about 30-40% of that level. So meaning the real impact of oil on the world economy was very, very small. It's very marginal. That's why you can see the oil market, the financial market, especially stock market, all of a sudden realize it really doesn't matter, especially on AI. What AI has anything to do with gasoline prices? Not much. So all I'm trying to say here is when something becomes very obvious, question about it. It's not. That's why I'm saying lots of people are very concerned about AI bubble today and everything. Most of the investors are actually very frightened about it. But before I go into that, I give you another reminder, and then we can go into the AI boom, whether it's a bubble or not. Let's unpack that. Another reminder is this. It's very important. If you look at U.S. history, every decade, there is a bubble. And that bubble always bursts in the earlier days of the following decade. It's like the U.S. Constitution. It has to have a bubble every decade. 1970s, the bubble was commodities and gold. That bubble burst in the early part of 1980. 1980s, the bubble was two things. The Japanese stocks went through the roof because at the time, the story was rising sun. Japan is replacing the United States, become economic superpower, going to take over the world. Stock market went through the roof. That's one bubble. Another bubble was junk bonds. Reagan deregulated U.S. financial industry. There was a huge boom in junk bond lending. That two bubble actually burst in the early part of the 90s. The U.S. got into a financial crisis called savings and loan crisis, and Japan got into deflation. That's 90s. And 90s, what was the bubble? Of course, it's internet. The first half of internet was boom, very real, very good. And the second half of the decades, the boom became a bubble. The bubble burst in 2001. Again, early part of the following decades. Of course, and then we move into 2000. What was the bubble? The 2000, the bubble was commodities. Remember the oil prices went through $150, and there was also a housing bubble in the United States. The housing bubble burst in 2009, and the commodity bubble burst in pretty much early part of the following decades. And then going fast in the 2010, people say, well, 2010, I don't see any bubble. And I out of your mind. If you think really hard, what was the bubble in 2010? It's government bonds. Remember, 10-year Treasury yields fell to 0.5% by the end of that decade. You will never see that again. That's a massive bond bubble that burst in 2022. Okay? So all I'm saying here is, this decade, we must have a bubble, and the bubble has to be AI. Why? I think it's written in the US Constitution. You have to have one. We will have one. The question today is, are we in the bubble or not? That's the key issue. Okay? I don't think so. I think we're in the AI boom, but we're not yet in the bubble yet. But we will go there. Let me tell you when and how. Why some people are very concerned about right now we're already in some kind of a AI bubble. One chart lots of people often talked about is the chart on your left-hand side. Let me explain what that is. If you look at the top panel on your left-hand side, that is the US total technology investment as a share of GDP. That's since 1980. A long-term chart. As you can see, that curve is always going up. It means that the US economy becoming increasingly more and more driven by technology. That's investment, tech investment as a share of US GDP. But as you can see there are two massive bulges. The first one is in the 90s, second half of the 90s. You can see the rise in technology investment was just so steep that it actually was a 2 sigma overshoot above the trend. That's a 2 sigma event. It's a massive boom. If you look at today, we're approaching that magnitude. We're also getting into 2 sigma overshoot. So that's why a lot of people are looking at that chart, holy mackerel, we are already in a bubble. I look at that chart, I say, well, maybe, just capital investment. You know, does that tell me whether this AI is in a bubble or not? Maybe there's a bit of an overinvestment, could be, but I don't see any evidence of that because each technology is different. We don't know whether this one is enough, not enough, just proper. We have no idea because this technology is just a new thing. But of course, we noticed that investment as a share of GDP is getting very high. Now, we have to look at other things and see whether other things telling me that we're already in a bubble or not. So that brings me to these two charts. I think it's very important. If you look at the chart here on your left-hand side, the top panel is U.S. corporate profit. U.S. corporate profit. This is not earnings per share data because earnings per share, you can manipulate that. You can buy back shares and try to sort of artificially increase your EPS. But this is based on full fund data. It's from national accounts. This is including all the big companies, all the small companies, the mama, papa shop, they are all there. What is interesting here is this. If you look at the chart here, between 1996 and 2001, the US corporate profit was already in recession. You can see that. I don't see this thing here, but anyway, you can see that the profit actually came down. Look at stock prices. The S&P 500 just went through the roof. So nobody cares. Even though profit actually was contracting. The narrative at the time, if anybody who went through the internet boom, was that if you have a negative EPS, earnings per share, your stock's usually trading at higher multiples than if you had a positive EPS. The narrative is that if you have a negative EPS, you're investing for the future. If you are profitable, you have a positive EPS, you're stupid, you're not doing anything. That's the narrative at the time. So it become crazy, and then that's why I think everybody dumped so much money into the internet, it basically drove down capital returns. Look at the chart here on your right-hand side. The bottom panel is the same thing. The bottom panel actually is EPS, earnings per share. You can see the earnings per share actually spend more time in negative territory than positive ones. Same story. You can see the earnings per share jumping around a lot because there's so many new issuance. The IPO went through the roof. Whenever you issue a bunch of IPOs, you depress the thing and then you try to manipulate back. So you can see, but still, the earnings growth, the EPS growth. Look at the right-hand side chart, bottom panel, spend more time in negative territory than positive one. And then if you look at top panel there, that's multiples, that's PE ratio. The multiples have gone through the roof. The multiples in the 90s went through the roof. You can see that. It's consistent with the chart here on the left-hand side because profit contracting, nobody cares, stock prices keep going up. Of course, you have a PE just went through the roof. This time around, it's very different. If you look at the chart here on the corporate profit side, right now, US corporate profits, we're talking about flow of fund data, is still growing at 12%, 13% per annum. Very healthy. If you think about stock market behavior today, any company underperform their profit expectation usually get punished very severely. People just dump their stocks. So in other words, I think the stock market is still acting very rationally. It's still very much careful about profits, which in my view is a good thing, okay? Which is a very good thing. So, another key difference I want everybody to keep in mind, remember this. The red line, if you look at the chart here on your left-hand side, you can see the red line and the blue line. The blue line is the profits. The red line is forward PE ratios. The top panel is S&P 500, the bottom panel is NASDAQ 100. So all I'm telling you here is this time around the bull market was completely, absolutely, totally driven by profit because there's no multiple expansion. You can see the PE ratio actually coming slightly down since 2021. Look at the NASDAQ 100, same story. The PE ratio actually came slightly down, where profit just went through the roof. Chart here on your right-hand side, that's a 1990. That's a bubble. As you can see, back then, there was no profit. It's all multiples. That's the difference. This time around, it's all profit, but no multiple expansion. Back in the 90s, it's no profit, but all multiple expansions. That's a key difference. That's what is called bubble. Bubble has to be a price. And when you talk about price, you're talking about how much you are willing to pay per unit of profits. Back then, you are willing to pay a lot, even though they don't have profit. But today, nobody want to pay a penny more as long as you keep your profit growth okay. Now, this is just adding a little bit more color. If you look at chart here on your left-hand side, this explains exactly what happened in the US stock market. You can see the red line is earnings, EPS. If you look at the blue line, that's stock prices. If you measure that from 2021 all the way to today, these two lines are moving up together. There was a period, actually, the multiples came down quite sharply. That's in 2022, when the Fed started to jack up interest rates, and then the multiple came down. But after that, everything back to sort of equilibrium. Now, what is happening here on this side of the chart here? Well, I'm just trying to get a gauge. of whether 22, 21, 22 times forward PE, is that a proper number? I'm telling you, again, you have to trust me, I'm not lying. You can check that out by yourself. In the 1980s and 90s, there is a very solid correlation between bond yields and multiple PE ratios. So, what is the correlation? It's very simple. If you invert the forward PE, you basically get stock yields. It's called earnings yield. Earnings yield and long-term bond yields, they were identical. They were not only moving together, they are actually equal to each other. From all the way from 1980s all the way to 1990s. That's when Greenspan figured out how to value stocks. He said, hey, that gave me a clue of how to think about stock market, whether stock market is over or undervalued. Very simple. You get your EPS, I stick in long-term bond yields, the result is your fair value of S&P 500. Basically, the same concept. So if you it says if you have 10% bond yields, your equilibrium PE should be 10 times. If you have a 5% bond yields, your equilibrium PE ratio should be 20 times. And if you have 4.5% bond yields, your multiple should be more or less 21 times. 21, 22 times. So that's exactly that. So I'm saying the market is still pretty efficient and not completely out of whack with reality. Again, forward earnings yield are equal to long-term bond yields. Applied to that, long bond yields at 4.5% is equivalent to a forward multiples of 22 times. Do your own math. So the valuation is not bad at all. Now we have to deal with the issue of whether we are over-investing or not. So how do I know whether the investment is excessive or not? The only thing that I can think of is to try to figure out the capital returns. If you have a diminishing capital returns, you know that you have dumped too much money into projects. So if you look at the chart here, on your left-hand side, the bottom panel, that is, think about that as your average capital returns. This is the data. Basically, you can find that data from the U.S. Government database. You can see that they call that sort of a profit per unit of value added. It doesn't matter. It's just think about that as average return of your capital investment. You can see that as expected in the second half of the 90s, that number was negative because the profit was contracting. That's obviously reflected here is a negative number. Now, I don't see that number, the bottom panel of your left-hand side, turning down. If anything, it looks like it's ready to hook back up again. So from that, I don't detect a clear signal that the capital returns are going to go down very much. And then if you look at Mag 7, right now the Mag 7 is investing a huge amount of money. Right now, if you look at the numbers, it's about $50 billion a month. That is a huge amount. If you think about it on a yearly basis, we're talking about $600 billion of new capital that are actually invested in data center. So the concern, of course, is whether these guys are over-investing or not. This is the realized capital return measure. It's basically your net operating income after tax divided by your invested capital. Right now, as you can see here, we don't have a clear signal that this return is going down. Of course, people are saying, hey, this is realized, how about expected? I said, if you do expected return, the things are getting more complicated. You have to introduce expectation and what would be your expectation, how that thing is determined. You can introduce a whole bunch of uncertainty, a whole bunch of factors that are out of control. But I'm saying, hey, just looking at the realized capital return today, I don't see a clear sign of overinvestment. So what are we talking about here? Boil down to what? I mean, people say, hey, Chen, you talk about boom. What is the story here in terms of macroeconomic impact? Two things. I want people to walk away with two things clearly in mind. Number one, this AI boom has been massively pro-profit. Okay? Look at the chart here on your left-hand side. That was internet boom. The blue line is US labor productivity. The red line is real labor compensation in real terms. The story here is back in the 90s when we had an internet boom, US labor productivity growth, basically, from the day one of this internet boom to 1999, that's pretty much at the end of this boom, productivity went up about 19%. Out of that 19%, you can see the laborers got about 10%. The rest was captured by corporate profits. Corporate profit gets something. Laborers get something. It's a division that is not completely skewed on one side or the other. Chart on your right-hand side is what's happening now. Look at the U.S. productivity. U.S. productivity growth has been growing at a basically total gains for the last 8 or 9 years. The total gains in productivity was about 22-23%. Labor got nothing, zero. That's the real compensation. Where the gain has gone, the gain has been entirely captured by profit. That's why people ask, U.S. nominal GDP grows about 4.5%. U.S. corporate profit has been growing at 12%. How possible? Answer is right here. They've basically somehow being able to capture the entire productivity gain. It's all gone to the profits. Don't ask me how sustainable. It has been sustained for quite some time. It may continue to be sustained for a while longer, but I think this is a very interesting thing that people need to keep in mind. That's the first thing people need to keep in mind. The second thing on the AI is that this is going to be hugely disinflationary. Because right now, everybody was concerned about U.S. inflation, everybody. Because oil prices, you can look at this little data here, is ticking up here, ticking up there. Inflation, everybody was fearful about that. I think the surprise will be that inflation is going to show up much lower than most people anticipate. And actually, the decline in inflation probably going to take place in the next 2 to 3 months once this oil shock is over. The passing through impact is done. So, why do I say this AI boom is going to become a bubble? I joke about it as a constitution, but no, actually there's a good reason for that. I can see two reasons that it can happen. The reason number one is I think oil prices is going to crash. Okay? Everybody was talking about oil crunch, but I think right now you should look 6 months out. I think oil prices are going to crash. The reason for that is if you look at history, the chart here on your left-hand side, the top panel, that's oil prices. You can see in history, every time oil prices double, it's always followed by 50% crash. It's almost like historical regularity. The reason for that is pretty simple. If you think about this chart here on your right-hand side, this is the alternative energy, nuclears, everything else. The surge was in response to the Russian invasion of Ukraine. That's oil shock in 2022. You can see the surge just went through the roof. We don't have the latest data. My guess is that curve, now it's probably right there. So the problem here is that once the demand destruction takes place, it will never come back. It's permanent. Oil demand destruction, whenever it happens, is always permanent. I think there are lots of oil. I think the Exxon basically estimated the damage in the Gulf region's oil facilities. It will probably take about 5 to 6 weeks to get it fully repaired. I think they are already beginning to repair that. It's not we don't have oil. We have oil. Oil is trapped inside the Hormuz Strait Hormuz. That's the problem. There's a lot of oil there, but it's not getting out. That's why I think Trump wants to get out of this war very badly. Don't hear him. He's just bluffing all the time. And also, I don't trust anything he said. Anything out of his mouth is a lie, except when he talked about stock market. He told us to buy Intel, doubled. He told us to buy stocks in April. I don't care about oil, but I would buy. Well, so he said yesterday, I don't care about oil, but I think oil price is going to drop like a rock. That's what he said. I think oil prices are going to drop like a rock. When that happens, watch out. The bond market is going to rally. Stock market is going to have parabolic move. Another obvious thing everybody was baked in is that he is going to face a tough battle to win the midterms. The out of consensus call today, you hear that from me, is that maybe the GOP is going to win both. Because by November, if he ends the war soon, by November, nobody in the USA would remember what happened in the Iranian war. Nobody talk about it even. And he is going to buy vote. Right now, it's about $560 billion of tariff money sitting right in the Treasury. He's going to spray that out, buy votes. And the problem here is Democrats, I don't see anybody talking about anything. Do you know who is running for Democrats? Nobody knows. I mean, where are they? I used to hear Chuck Schumer talk about stuff, but right now he's completely, I'm not saying he's dead, but I don't hear him anymore. So, we will have a bubble, but we're not yet in a bubble. I think if you use historical roadmap, probably towards the end of this decade, the bubble is going to get popped up. But we're not there yet. Just to remind you one very famous line that Sir John Templeton used to tell us, which is if you think something's a bubble, times 2 and retreats 30%. That's when you want to sell. Basically what he's saying is, if you think something is a bubble, that bubble usually lasts twice as long and go twice as high. And then because you are not smart enough to time the end, retrace 30%, get out. I did my simple calculation. Times 2, retrace 30%, bring us to S&P 500, 10,050. That's when you want to sell. But this is just a joke. But anyway, all I'm trying to tell you is we're not there yet. Because the bubble usually built on falling rates. Bubble do not build when rates, especially borrowing costs, still very high today. With that, I'm done with my work.
Yes, I'm going to invite you to kindly please take a seat. We can take these two center seats. Thank you so much, Chen. We don't have a lot of time, just about 10 minutes or so together. And so again, I'm going to take some of the questions from the audience.
Sure.
But let me start off with this. Having listened to your analysis and some of your calculations, let's land this a little bit. What are some of the structural themes then you think are really going to shape the global investment agenda? And maybe let's give it a time frame in the next 3 to 5 years.
I think this AI story is going to be massive. I think there will be a huge productivity boom that is going to happen everywhere. If you borrow what happened in the 90s, it's very interesting. 90s, there was an internet boom. And as a result of internet boom, lots of that boom actually went to consumer surplus. Consumer surplus is actually part of the GDP, but never been captured by data. Just to give you an example, I was a university student in the early part of the 90s. I was doing my PhD at the University of Illinois. At the time, a China call, long distance call, cost you $12 a minute. So I was a poor student. I was trying to call my family, and it cost a lot of money. So what happened is that I basically have to write down everything I want to talk to my mom, and then I dial and just, in 2 minutes, you basically deliver 2 pages of information, what do you want them to do, whatever. And today, anybody who has an iPhone, you can basically deal with that at ease. So the point I'm trying to say here is, this thing is going to be revolutionary. I don't know where it's going to take us, but I think the productivity aspect is going to be huge. A big chunk of that probably going to profit, but the other chunk is probably the same thing, consumer surplus. I can't live without ChatGPT. I ask everything, anything. That's the reality. So that is one aspect. The other aspect, I think, is the disinflation aspect. Everybody in the U.S. is talking about inflation. You know, there's going to be inflation, oil prices, tariff, the inflationary. I think the unanticipated shock for the rest of the world in the next couple of years is going to be how low inflation is going to go.
Let's bring the opportunities lens into this conversation. Where do you see the most compelling opportunities then, particularly for emerging markets? And of course, we just had a conversation about the African continent with Jeffrey Sachs. And prior to that, if you look at that landscape, where do you see the opportunity?
I think I'm very tempted to say, hey, you want to buy emerging market. But when you think about emerging market, you're really talking about China. China is a really great story, but it is not a great profit story. If you think about China and the United States, they run diametrically opposing economic model. The US economy is organizing in one principle, by one simple principle, profit maximization. It has always been like that. If you think about US so-called exceptionalism, it's basically the same thing. They always maximize profit. That's US corporations' the single objective. Whereas if you think about the Chinese economy, that's not the same objective. If you think about the Chinese economy, every year produces like a 4.43% of national savings rate. Have you thought about this mind-boggling numbers? Every year, the Chinese economy have to invest about $8 to $9 trillion of new savings into the economy.
Yeah.
That's why you don't have profits. I'm sorry. I mean, anything that remotely profit is going to bid away. I mean, everybody want to be their own boss. Everybody want to invest. Think about China's EV. You know, Professor Sachs is right. They achieve the dominance, but there are 200 EV makers, and they produce the biggest quantity of EV and good quality too.
Yeah.
But the whole industry make less profit than Toyota. You want to be investing in Chinese stocks? Be my guest, but I think you're not going to make much money.
Sure. So I want to talk a little bit about asset classes and get a little bit more granular by asking you to point us to the asset classes, maybe even the sectors that you think are best positioned to outperform in this new investment environment.
Oh, okay, great. So there's lots of things I want to talk about. I don't have time, but I think the first thing first, if you look at the US AI everybody was frightened about it. I think it's still, as I said, we're not at the end point of this AI boom. So I would say, hey, all this high-flying stocks, very few fund managers actually like them. That's reality. I even pissed off at my own money manager. He was, I don't want to touch that. I said, why you don't want to touch that? Well, I have never touched it. What's you've done? But basically, you're missing out. So the point here is this. I think this AI is still going on. It's a still ongoing story. So if any pullback, I think there'll be a shakeout at some point.
Yeah.
You want to buy. That's one. Another thing is that the U.S. power.
Yeah.
It's a massive problem. I have a condo in Miami, and every year I'm pissed off. Every year the power prices, the electricity prices, gone up like 8 or 9, 10% for the last 3 years. That's a regulated industry. If it's unregulated, the price is going to be 15, 20% a year. Basically, revealed preference telling us there is a serious shortage in power. So I think one interesting area you want to think about it is industrials. Like a Caterpillar.
Yeah.
You need a lot of bulldozers to build all those power plants. I'm a simple man. I'm just saying, hey, you need those things to dig things out and then put infrastructure into place. So I think industrial stocks are something that you need to think through. And of course, AI diffusion is a huge deal. All the lagging sectors, you look at their profits, they're all catching up. They are all catching up in terms of EPS growth. They are approaching to the Max 7 level. So I would say, as a fund manager, I would do a barbell strategy. I got a bunch of money that's still in AI. The other bunch probably in the value stocks.
Yeah.
Why not? The final thing here, I think the commodity is in a secular bull market again.
Yeah.
Can you share my chart again? Is that possible? Quickly.
So while they pull it
Yeah.
up and you make that comment on commodities, there is
Yeah.
a question that had come from the audience that says,
Yeah.
what is your view on commodity prices,
Yeah.
in particular gold and PGMs, which is where some of our strength lies?
Yes. Would it be possible to show me the chart? Because I can give you a little. It's a really long-term chart from about 100-some years. I don't think you're doing that.
I think we
But
might
anyway,
just have to speak to it for now, yeah.
But anyway, it's about 4 complete cycles in terms of commodities. So 10 years up cycle, the 10-year down cycle is always repeating in that pattern. So now we're into year 3 or year 4 of an upturn. I think that's going to be a good story. You can see that. Really important. Here we go. Chart on your right-hand side.
Yeah.
This is from 1900. Okay? 4 complete cycles. We're halfway to the higher level. So anyway, if you are interested in the chart pack, there's a barcode. You can sort of take a picture. We're going to send you the charts. It's I think commodities, particularly in this country, if you look at real gold prices, we're not finishing the bull market yet.
Yeah.
So that's something you want to think through too.
I've got a minute on the clock. I'm going to squeeze one more. There's a question that says, do you think there's a looming risk of a crash in the global bond markets, given the high levels of sovereign indebtedness in global markets? And does this then trigger a meltdown in global equities?
No way. I took it away, but anyway, it doesn't matter. The picture is better than looking than me, but anyway, they want to prefer to look at me, so that's fine. What I'm saying here is, think about the United States. Everybody was talking about the sovereign risk. I said, what are you talking about, really? The U.S. nominal GDP was 4.5%. U.S. bond yields was 4.5%. So remember, when we were taught at universities, equilibrium bond yields should be more or less equal to your nominal bond yields. It was not the case last decade. As I said, there was a bubble because central banks expanded balance sheet, pressed interest rate to 0, in some cases negative. That's why you had a bond yields that are way below equilibrium. But right now, the central banks are severing the link, the balance sheet of central bank are now severed with the fiscal authorities. So now you have to run a more or less normal fiscal policy. Think about the U.S. That is always, people say, hey, that's always a risk. But hey, what are you talking about? 4.5%, it should be something like, if U.S. bond yield is about 5.5, that's problematic. 4.5, perfect.
Ladies and gentlemen, I think we're going to give Chen a big round of applause. Thank you so much for your insights. Thank you very much.
Thank you.